So a question I get asked a lot by homeowners who are applying for a loan modification or considering applying for a loan modification is, what is the bank looking for? They want to know, tell me the magic formula that I can submit to get approved for a loan modification. What does the bank want to see? There are so many different investors out there, and there are so many different lenders. It's almost impossible to give a general answer in a video in this format without talking directly to the lender, without understanding who the investor is, the particular investor guidelines. But I thought it would be beneficial to just go through kind of 5 general things that do show up in a loan modification review process. But please understand, if you're watching this, that the best thing you can do is consult with an attorney in your state, tell them who the investor on your loan is, who your bank is, tell them your entire financial situation and your history, so you can get an answer that's a little bit more tailored to your situation. For general purposes, there are kind of 5 things the lenders are looking at when they go through a loan modification review. I'm just going to quickly talk through them. So the 5 things are a valid hardship, number 1, stable income, number 2, affordability of a new mortgage payment, that's the 3rd. The 4th is whether or not you should be on a repayment plan instead of a modification. And the 5th thing is your prior modification history or prior modification attempts. So valid hardship, number 1. Basically, banks take their mortgages seriously, right? And they want you to take your mortgage seriously. And so part of the loan modification review process is the bank looking at what caused your default in the first place to make sure that you didn't default irresponsibly. There are other videos in the document section here, in the loan modification section here, about your hardship letter and the valid hardship reasons. Go watch those videos. They give you information about what types of hardships qualify as valid hardships. But basically the general understanding here, is that the banks want to make sure that you didn't prioritize expenses that shouldn't have been prioritized over your mortgage. So if you're somebody who, for example, bought a big expensive boat instead of pay your mortgage payment, that's probably not going to be a valid financial hardship. There are 5 valid financial hardships. There's, like I said, a different video posted that goes through each one of those individually. But overall, banks are looking to make sure that the reason that the default occurred fits within these reasonable reasons that the banks have deemed appropriate for somebody to both default on the mortgage and then want to get back current. They're vetting you to make sure you're not an irresponsible borrower. So go watch those videos. They're pretty broad. The hardship categories are broad, so you should be able to fit what happened to you into one of those categories relatively easy. The second thing is that the bank's looking for stable income. Banks don't like defaulting, right? That costs them money, because then they have to start to kind of put you through the default process. They might have to pay their own foreclosure trustee or their own foreclosure attorney to do something and start moving forward. So if the bank is going to approve you for a loan modification, they want to make 100% sure, which they never can, but they want to make as sure as possible that you're not at risk for re-defaulting or defaulting again. A worst case scenario for a bank would be they go through the entire loan modification review process, they give you a loan modification, and then a month after you make your new modified payment, you default again. And so the bank looks at the income that you're bringing in, and they look at the longevity of it. They look at whether it's temporary income versus stable income. They look at, whether you are bringing in kind of like bi-weekly pay stubs that are coming in a regular manner, or whether you have, more kind of fluctuating, more temporary income. Again, there are other videos posted about your different kinds of income and how to best present that to the bank. So after this video, if you're wanting to get more information about how to kind of show the bank that you do have stable income, or how to present income that might appear unstable in a stable way, there's other videos about that. So you can kind of go to the documenting your income videos and watch those there. But that's another thing that the banks are looking for. They want to make sure that if they take a risk on you and allow you to kind of resume making payments with a loan modification without having to pay the full amount, that you're going to be a good investment for them, that you're going to make it through your modification, fully pay back what's owed, and not be at risk of defaulting again. The third thing that they look at is affordability of the new payment. Overall, that means the bank wants to make sure that if they put you on a new modification with a new modified payment, that it's affordable for the household. Like I've said in other videos, I think there's a misconception out there that if you get a loan modification, your payment's going to go down a lot. Sometimes payments do drop, sometimes interest rates do drop, and sometimes banks do reduce some of the principal. But situations where you fall into default and then you modify your loan is not very often going to result in you having a much lower payment. They're not going to usually slash your payment in half or do anything dramatic. They're typically going to give you a new agreement that allows you to move forward making payments, and typically those mortgage payments are going to be very close to what your original payment was that you defaulted on. This is part of the reason why loan modifications are not perfect options for people whose entire financial circumstances have changed so much that original payment still isn't affordable. If your original payment still isn't affordable, a modified payment likely isn't going to be affordable for the household either, and you might want to look at some other options. But the bank is looking to see if the payment is affordable. And there's two things we can kind of talk about here that they look at. One is called your front-end debt-to-income ratio. A front-end debt-to-income ratio simply is the ratio of your mortgage payment to what the household is bringing in. It's simple math. You calculate your monthly household income and you look at what that original mortgage payment is, and you can kind of look at how that shows up, right? Banks are trying to avoid a situation where they give you a modification and then the mortgage payment eats up almost the entire amount of the monthly household income. The reason they don't like that is because, number one, that would create a very stressful financial situation for you as a homeowner or borrower to live in, right? Every month you have to pay like 90% of your income toward your mortgage. That leaves very little money to live off of, to entertain yourself, to cover emergency expenses. And so banks see that as being kind of a red flag and kind of would put you in a light of not being a best candidate for a loan modification if most of your monthly income was eaten up with your mortgage payment. Different investors have different guidelines for this ratio. Some of them don't abide by strict front-end ratio guidelines, but the general rule to just kind of think about in your brain is a mortgage payment should be about 30 to 35% of your monthly household income, meaning like up around a third. If you have, a certain amount of income coming in every month and a third of that goes to your mortgage payment, that leaves plenty of money to eat, to, pay taxes, to pay utility bills, to do other things. And so banks look at this front-end ratio as one of the things they look at in order to determine whether a modified mortgage payment is actually affordable for you. The other thing that they look at is what's known as a back-end debt-to-income ratio. A back-end debt-to-income ratio is kind of just a fancy way of saying they look at the ratio of all of your household expenses compared to your monthly income. So they would take a proposed modified mortgage payment, add that to all of your other household expenses coming in, and then run that against your household income. Again, different investors have different guidelines for that. Sometimes they care more than other times, depending on who your servicer is or who your investor is. But again, a good kind of general rule is 50% would be good. Anywhere from kind of 45 to 65% back-end debt-to-income ratio is something that, would be reasonable for you to present yourself as a good candidate for a loan modification. And what that means is banks want to see, when they're considering whether to modify, that you could make a modified mortgage payment and you could pay all of the other required expenses that you have to pay in order to live, and still have a little bit of money left over every month for unforeseen expenses. Lenders are not interested in putting people back into modification plans where their mortgage payment and their required utilities cover almost 100% of the monthly income. The reason they don't want to do that is because what that means is the moment that you have some sort of emergency expense that was unforeseen, you don't have any additional funds to cover those emergency expenses, and then you put yourself back in a situation where you might default again. And so a back-end debt-to-income ratio, basically adding all required household expenses and a mortgage payment compared to the monthly income, should still leave a little bit of room, should still leave a little bit of extra money at the end of the month, so that the bank who's trying to approve you will feel assured that if something unforeseen happens to you, you can still continue on with your mortgage payments and cover emergency expenses. There's more information for this for you at your specific lender with your specific investor. Again, this is mostly general information. The fourth thing that they're kind of looking at is whether you should actually be put on a repayment plan instead of a loan modification. There is a separate video here about what the difference between a repayment plan and a modification is, but just real quickly, a repayment plan is a way for a homeowner to resume making their regular mortgage payments and pay a little bit extra every month until they're fully caught up on their existing loan. Compared to a loan modification is kind of the writing of a new loan where they take everything you owe, put it on the back end, and you pick up making payments. A repayment plan is different. It's a way to literally repay to get you back current on your existing mortgage. Again, watch the video if you have kind of more specific questions about that, but that's the difference. When you apply for a loan modification, the bank is trying to see if they can, instead of having to approve you for a loan modification, could approve you for a repayment plan. Now, this might be something that works well for you. This might be something that you want. Banks often choose to approve a repayment plan when they show so much leftover income every month that they think that you can easily afford resuming your monthly mortgage payment and paying another high amount every month toward your arrears. And so where some, people have run into trouble is they present such low household expenses that their back end debt to income ratio, meaning their full household expenses, including the mortgage payment, is so low, there's like several thousands of dollars left every month. When the bank, if you show that to a bank who's reviewing you for a modification, they're gonna say, hey, not only can they afford to resume making monthly mortgage payments with a modification, but they can also pay us an extra, $2,000 a month to quickly catch up on this agreement. And as we all know, banks are creditors. And so if they see that that's an option, they do have the ability, some investors, some lenders have the ability to pivot from a modification review and actually approve you for a repayment plan because you've shown them that it's so affordable to you, you can make these very high payments. So one thing that I see borrowers go through is they think that, removing a bunch of expenses or not reporting expenses is going to help them get approved for a modification. And then they actually end up approved for this very unaffordable repayment plan. And then at that point, you kind of have to undo that and go back and, resubmit a different expense form. So applying for a modification really is about finding that sweet spot where you're showing the bank, hey, I can resume making regular mortgage payments. I do have enough money left over every month to cover any unforeseen expenses. However, I don't have so much money left over at the end of every month that I can pay you an exorbitant amount of money. If you have so much money left over every month that you can make a high payment and get current on your existing loan within a few months, then maybe a repayment plan is the right option for you. But you want to talk to somebody who kind of understands your financial situation so that you make sure you're kind of applying for the right option for you, because banks will evaluate a modification request against a repayment plan request as part of the review. The fifth thing that banks look at is your prior modifications or kind of prior modification attempts. Again, this is very lender and investor specific. Some investors say that if you have had, some investors limit the amount of modifications you can have forever. So a very common one we see is some investors say you can only have 2 modifications for the life of the loan. What that would mean is if you have modified your loan 2 times, you're done. So it doesn't matter how much time has passed, you can only have 2 modifications. Other lenders have different guidelines, like you can only apply for a modification once every 24 months, which would be 2 years. And some lenders reserve the right to, give you only 1 modification attempt, but they're all different, but they are going to be reviewing what you've done in the past versus now, and they are able at sometimes to use those prior modifications as reasons to not approve you for a loan modification. So those are mainly the 5 things. Just to repeat them, we've got whether you have a valid hardship, whether you have stable income, the affordability of a new payment using those ratios we talked about, whether you can actually afford a repayment plan, and some of your prior modification attempts. And just to conclude here, everybody's financial situation is different. Everybody's investor and lender is different. And so the best thing you can do when you're asking that question, like, what are you looking for? What does the bank want? Is to talk to an informed attorney in your state, or, speak directly to your bank and see if you can get to somebody who has good information for you. Thanks.